Hello, this is our final case presentation on Walmart by Grace Burr, Kelsey Carrier, Barbara Fleming, Emily Morris, Shane Rosen, and Caroline Ward. Walmart was founded in 1962 by Sam Walton. It was built around the idea of offering the lowest prices on merchandise and superior customer service. Walton's strategy obviously worked, and by 1980, Walmart had reached $1 billion in annual sales, reaching this goal faster than any other company at the time. Walmart further differentiated their stores by opening the membership-only wholesaler Sam's Club in 1983 and the Merchandise Plus in-store supermarket, Walmart Supercenter, in 1988. By 1990, Walmart was named the nation's #1 retailer. 1997 also marked an important milestone for Walmart as they reached $100 billion in sales that year. Walmart dominates the low-cost global retail industry. Today, as the face of retail is changing with the expansion of e-commerce and online shopping, Walmart's CEO C. Douglas McMillon wants to continue the path of technological innovation by creating a seamless shopping experience between the digital channels and the physical stores themselves. Currently, Walmart employs 2.3 million people. Revenue has been climbing in recent years, however net income is falling due to rising operating and SG&A costs. Of total sales, 76% are in the United States. Based on pest analysis, the general external environment is attractive and strong. Politically and economically, there is an opportunity to grow internationally and strengthen its international strategy. Socioculturally, there is an opportunity to increase its inventory of environmentally friendly and healthy lifestyle products to stay in line with recent trends. Technologically, Walmart faces both an opportunity and a threat with the rise in smartphone usage. It will be important to focus on capitalizing on the rise in e-commerce by improving its online and in-app shopping platforms, specifically for smartphones, in order to minimize the threat of being left behind in an increasingly digital age. Based on the Porter's 5 Forces industry analysis, the target industry in which Walmart competes is moderately attractive with moderately high profit potential. However, Walmart will still need to minimize the threat of new entrants and rivalry among competitors. One way to minimize these threats is by leveraging its size through economies of scale and passing any cost savings to its customers. Additionally, Walmart should seek new channels in which it can integrate backwards in its supply chain and sell products using Walmart's private label brand. It is important to recognize that the firms competing in Walmart's industry may also compete in several product or geographic markets, resulting in multi-market competition. Therefore, Walmart can predict the dynamics of its competitors' actions as less likely to initiate attacks, but more likely to respond aggressively when attacked. Taking note of this, Walmart should try to avoid aggressive strategic action and focus on tactical actions. Based on the VRIN analysis, Walmart's core competencies included supply chain management, international presence, bargaining power, data analytics, and brand name. In terms of supply chain, Walmart's unique centralized management information system allows for effective control of inventories. Its international presence allows it to grow and strengthen its market position by diversifying its revenue sources, learning from new experiences, and growing its economies of scale. As the largest retailer in the world, Walmart has significant bargaining power over its suppliers and buyers. Walmart's extensive access to consumer data and its data analytics capabilities allow it to obtain valuable information in order to track consumer demand and satisfy its customers' needs. Lastly, its brand name serves as a core competency as it is well known for its everyday low prices. SWOT analysis helps to determine the best business strategy to implement. Walmart uses a cost leadership business strategy. This strategy is the correct choice for Walmart as its product characteristics are relatively standardized with features that are broadly acceptable to many customers that are sold at the lowest competitive price. Walmart's strengths are well in line with the cost-saving actions required by a cost leadership strategy. Here we see Walmart's ECV compared to that of its competitors. It is clear that Walmart's low-value, low-cost strategy is creating economic value, which allows it to maintain its competitive advantage. However, 2018 showed a lower ECV compared to previous years. This indicates that it will be important for Walmart to fine-tune its strategy in order to be considered a going concern in the future. Walmart's corporate strategy and overall level of diversification is related constrained, which is the most profitable strategy. Its diversification can be broken down by store segment, types of store, in-store diversification and alliances, and brand acquisitions. Walmart's three store segments are Walmart US, Sam's Club, and Walmart International. They all serve different customer bases and customer needs. Under these three umbrellas, Walmart has more business units in the forms of store types, brands, subsidiaries, and partners. Walmart runs many operating divisions that serve different retail purposes and customer bases, which are the Walmart Discount Store, now known as Walmart, Walmart Supercenter, Walmart Neighborhood Market, and Sam's Club. Walmart stores are diversified in that they supply in-store services such as pharmacy, photo, and garden, and partner with the different types of businesses, including fast food shops, salons, and banks. Walmart, as well as having operating divisions, has a vast brand portfolio. It owns many subsidiary brands which have helped it to expand its e-commerce platform, media technology, and retail options. In acquiring these brands, Walmart seeks to create reciprocal synergies in the value chain. Reciprocal synergies are key to Walmart's success in acquiring companies or brands so that Walmart and the business can work together to produce a less costly or more valuable product or service for a customer. Walmart's in-store diversification, specifically in Walmart Supercenters, has led it to be one of the most successful companies in the world. Walmart seeks modular synergies with their in-store partners as it produces two separate products or services but still creates value for both businesses by being located together. This type of partnership is known as a non-equity alliance, in that no ownership is shared between the two businesses. Having these services and restaurants inside Walmart Supercenters reinforces the one-stop shop image in consumers' minds, which attracts more and more frequent customers. Based on the BCG matrix analysis, Walmart should continue to invest in their cash cow Sam's Club stores, as they do not want to lose market share to competitors such as Costco and other wholesalers. Instead, as it has low market growth, Walmart should not invest in new product development, research and development, or innovation. Instead, it should allocate those resources to neighborhood markets, which are a high-growth industry but are one of Walmart's lower market share business units. It should continue to invest in this segment while leveraging its superior supply chain management and distribution to be a cost leader in the segment. With more investment, Walmart could see a huge payoff in the segment and see neighborhood markets shift from a question mark to a star. Finally, the Supercenters, Walmart's current star, should continue to be invested in as the market has steady growth and Walmart has one of the largest relative market shares. Strong corporate governance is important to Walmart. Policies are reviewed and evaluated frequently by board, independent directors, and even third-party consulting firms. Recent changes have been made to balance compensation for both short and long-term incentives and to reward strong performance. First of all, greater differentiation to annual salary adjustments has been implemented. Secondly, annual cash incentives opportunities were reduced by 25% and reallocated to long-term performance-based restricted stock units in order to emphasize long-term results. Institutional holdings represent 29.94% of shares held, with the Vanguard Group as the leader. Once Walmart became successful in the U.S., it began pursuing international markets. After looking at many markets, Walmart decided to enter Mexico first, partially due to NAFTA's impact on trade. Europe's mature economy made it a difficult market to enter, and U.S.-based companies generally do not have a good track record with entering the Asian market. Walmart began to expand internationally in 1991. The company had an opportunity to increase profits by expanding outside of the U.S.'s saturated market. Investing further in emerging markets like China and India offers large mediums for discount retail growth due to low disposable income of customers there. Despite their benefits, China and India also pose institutional voids for Walmart. China's underdeveloped infrastructure, government limitations on foreign investment, and absence of consumer information make it a complex market. India also lacks the necessary infrastructure and has cultural aspects, such as the caste system, that are difficult to navigate in a business setting. Here is a compilation of our final recommendations for Walmart, ordered from most to least important. We think that it is most important for Walmart to focus on gaining market share in the e-commerce market, as this is how the industry is shifting today. It is also important that it takes care of bad publicity that it is receiving, as it could be affecting current sales. The recommendations we found least important were those that suggested continuing the current course, as the purpose of those was to highlight things that we think Walmart is doing well and should continue, not change.